Good day. This is the second part for our discussions about short-term non-routine decisions. You can see here another term for relevant cost analysis, and the decisions would be non-routine operating decisions. So emphasis on relevant costs, which should be avoidable and future-oriented, and they should be differential or avoidable. So the avoidable is actually another term for differential costs and revenues. So we have here operating, since they're still done in the short term, if not day to day, but at least for less than 1 year. So there has to be some of these examples of non-routine operating decisions being done by businesses on certain periods of less than 1 year. So a review of key topics. So we have the opportunity costs, these fixed costs, avoidable or unavoidable, and then the qualitative factors and uncertainties. So opportunity cost, benefit foregone of choosing one alternative over the other, or choice or option over the other or others. Avoidable fixed costs are fixed costs that would change on certain alternatives or options or choices. Remember, fixed costs are actually normally non-differential, but some fixed costs, because of certain situations or certain transactions that are to be made or decision making to be made, that's why these fixed costs could change among alternatives and they become avoidable or differential. On the other hand, if we say unavoidable fixed costs, so clearly they do not differ among alternatives or choices or options. And they could be, for example, sunk costs. We also use qualitative factors for our analysis. So in real life, if, for example, that is, let's say, not able to pass our screening based on quantitative analysis, but because of the qualitative factors, then such could pass. So there are also other cases about that. And uncertainties wherein we do not know what can happen. So this would be parts on especially non-routine decision making. So here are some examples. We are done with first, and then keep or drop, we are done with that. For product emphasis, we're done, or some parts like on the cannibalization or the complementary effect, and then make or buy on the next session. So I will go back to our PowerPoint presentation for the discussions that we will have as continuation. The continuation will begin with loss leader. In loss leader, this is a case or special case of complementary effects or cannibalization, wherein a product or line shows a negative profit in the sense that its contribution margin does not cover its avoidable fixed costs. So basically, the contribution margin that is created by one sale, for example, of a newly issued product or anything that is being sold, is not going to be sufficient to at least equal the avoidable fixed cost created by that. So an example here in the next slide would be the manager of a local pizzeria prepares the income statement shown. This is slide 5-19. So the next is 5-20 based on the normal week for the 11 a.m. to 2 p.m. period. And then we assume that all costs are incremental. So we have here for the loss leader, so we have the sales, 200 pizzas at $1.80. So we multiply that, that's $360 for soft drinks and so on. So we can notice that the total contribution margin is 300. The wages of part-time is 80. It actually constituted $220. So in this case, the loss leader here is not shown clearly on the face. Now, the loss leader here, if I'm going to check, is that if you assume that the wages of part-time employees $80 will be charged to soft drinks, thereby creating $20 loss. That could be the case because if I take it as a whole, like 80 is, for example, to the company as a whole, then that would still be a profit. So we cannot see as to where is the loss leader there. So probably it's 60 minus 80, negative 20 then for the soft drinks. Anyhow, so meaning zero wages of part-time employees for pizza. All right, so at least we got the concept for that. Next is make or buy decision. So in this case, there is a decision to produce 12,000 units of a product or buy from external source. So it's either we make or produce our own or manufacture our own or create our own or buy or purchase from outsiders. So here are our items from rental to the overhead. And then these are our unit costs. So if we divide these items by 12,000, we get the unit cost, and this would be the $8.25. So you can check if 99,000 divided by 12,000 is equal to $8.25. Then let's say that the purchase price from an outside vendor is $5.50 per unit. So initially, if you are going to compare, we'll be saying that, oh, let's buy from the outsider because it is lesser than unit cost. However, to decide, then we will only be selecting, for example, the costs which are actually variable and avoidable to make or for making. So in this case, we are going to select, of course, direct materials, direct labor, and variable overhead as part. And then for rental, yes, but for fixed overhead and equipment depreciation, we are going to disregard because these are fixed costs and they do not differ among alternatives, unless it is to be stated in the problem that they would differ, especially for fixed overhead if a portion of this is avoidable. So we are going to place that under make then. But because of that, so we'll only use rental of equipment. Probably this is like an opportunity cost. So let's say if we rent out the equipment, so this would be the amount that we are going to pay, for example, or we are going to suffer along the way. But it seemed that because this is an addition to cost rental of equipment, so probably to make the product, then we are going to rent equipment. So that's why it will be a cost, an incremental cost. So this would be the total relevant cost to make, and the buy is $66,000, prior is $53,000 respectively. So question is, where are we getting for those? For the make, it's given for purchase price, that's 12,000 units times 5.5 per unit. So we get 66,000. And therefore, if we compare the two, these are costs. Therefore, we are going to select the lesser. So it is better for the company to make because of $13,000 advantage, or let's say an incremental value on the part of the company as an advantage because it has lesser cost to make. All right, that is the decision, manufacture parts in-house. Then qualitative issues. So for example, let's say, yes, we are deciding to manufacture for our company, but are we using quality products? So are the components purchased of quality? Are they delivered on time so that we are going to produce the products needed for sale? And what if there would be increases of the prices of these components along the way? So there's a possibility. These are the qualitative issues that cannot be answered by our quantitative formats. All right. So that is done for the make or buy decision making. Another one is joint products. So what if there will be two or more separate products that can be produced from a single manufacturing process? So let's say, for example, the production of petroleum or oil. So there could be some products that could be produced as we produce the petroleum. So could be like asphalt, could be components for alcohol, and etc. So how do we account for certain items and as well as the decision making that we are going to do? For example, if we are going to sell it as it is, or we are going to process further to earn more revenue but have more costs. So that would be one case to happen. or those cases can happen. Anyway, to continue, QBT, a chemical company, operates a joint process that results in two products. So each 1,000 pounds of material yield the following or as follows. So these are the details now after that. So again, there are two products produced by a joint process, then each has 1,000 pounds of material yield. And these are the additional information. So if we sell the products at split off, then these would be the selling prices. Should we decide to process further, this would be the prices. And these are additional cost variables, so incremental differential, then these should be considered. All right. So for as long as the incremental profit would be, of course, positive, it's incremental, it's greater than zero, so we are going to process further. That's how we are going to analyze. So differential revenues minus differential cost, it's going to be $1,500 for alpha. It's a positive, so we process alpha further. But for omega, we are going to sell it as it is, because if we are going to continue processing, then we are going to lose $100. So omega should be sold at split off point. To go back to the previous slide though, so how do we compute the incremental revenue? So the difference, this is 24. So 24 minus 900 is 15, that's positive. Here, this is 400 minus $500. Of course, these are in dollars, equals $100 loss. So alpha, process further and sell after processing, while omega, sell it at split off point. We are better to leave it off. Also, we can use this analysis. This is 2,000 minus 500, that's 15. And then 16 if sell at split off point. So 16 minus 0 cost, that's 16 profit. Minus 15 here if we process, so that would be a negative 100. So that's why you have to sell it as it is. For alpha, this is 36 minus 900 is 25. Is it? Or we can check that out. So 36 minus 900. All right, that's 27 rather. 27. Then minus 12, that's $1,500. So that's why we have to process further alpha and get additional profit. All right, so hopefully you were able to get the point, and any methods would work though. You can follow the method shown here in the PowerPoint or follow my suggestions. All right, so that is for joint products. Next, for special order. So let's say these are the sales for the special order, then these are the manufacturing costs, then other components to get operating income. So how do we decide? So should the company, I cannot view everything, so I will minimize. Should the company sell a special on-time order for 20,000 at $10 per unit to a company in a new market? So out of this information, should the company sell one-time order or on-time order, especially for this one for 20,000 units at $10 per unit to a company in a new market? So how do we decide for this one to make the decision if we are the manager here? So we are going to consider, of course, the incremental revenue and incremental costs only. So probably you are going to make use of materials, direct labor, and 1/3 variable, only the variable overhead to be considered. So the differential revenues would be the 20,000 units times the $10. So the price, if we are going to proceed with a special order, then the incremental profit then would be $20,000. So in other words, we will proceed with the special sales order. If I will just go back to the previous illustration, so we have your selling administrative expenses. It's not shown here like if they're going to change among alternatives, so we will simply assume that they're not. Then another situation here, but we have to go back first. So the decision is to accept the special sales order because of $20,000 incremental profit. So accept special order decision. What about if this example? So let's say new revenues 20,000 though, but there are lost units. So this is a case of cannibalization again, or complementary effect. So there's a reduction of sales for existing products, and then the cost of special order at 180, but costs from not making regular sales as follows. So we have here, these components are the variable manufacturing costs, and this would be the commissions additional. So costs from not making the regular sales. So in that case, so we can then say that these costs are associated for the lost revenues. All right. So these are the total differential cost then. And so the differential loss favoring rejecting the order will be $8,500. Right? So meaning we have, or we are going to reject the order then. So that was for special sales order. Next, what about for resource constraint? So example would be, let's say that in the company, there is limitation on the resources that can be used for the production. So which products should be prioritized by the company? The answer is that whichever product or products that would contribute or that would produce the contribution margin per limiting factor or resource constraint, whichever is the higher or highest should be prioritized. So in this case, the contribution margin is, of course, difference between selling price and variable cost. So that's $4 per unit and $2 per unit for drive, chip, and modem chip, respectively. And the number of units that can be made per machine hour is 60 and 150, respectively. And the question would be, which product should be processed, assuming only 100 machine hours are available? If you are going to look at this one, the modem chip has, of course, 150 units that can be produced. So we are going to divide to each. All right. So 60 units for drive chip though. So 4 divided by 60, that is 0.06666. So that's going to be 0.07, for example. And 2 divided by 150, it's 0.01. So we are going to show that here. And so the decision for this one is that we are going to, of course, if we will assume that these amounts here, 60 and 150, as what I've insinuated a while ago, are actually the machine hours. So that's why our basis would be whichever is greater, 4 divided by 60 and 2 divided by 150. However, because this is that these are the units that can be made per machine hour. So to get the contribution margin per machine hour being the resource constraint is we will multiply them. So 4 times 60, that's 240, and 2 times 150, that is 300. So in this case, we are going to produce the modem chips. A while ago, if these are really the machine hours, then so 4 divided by 60, that's 0.07. 2 divided by 150, that's 0.01. You can verify by your calculator. So 0.07 versus 0.01. So we will really produce the drive chip. But we will respect the problem because this is what is given. All right. And then decision making under environmental constraints. There could be some loss that can be present in the company or in the environment, or that would affect the company. So example would be the antitrust laws that forbid actions that might substantially reduce competition. So meaning this is to regulate because there could be some unfriendly practices that would exist in the market of the specific products. And of course, there are specific markets. Anti-dumping laws address aspects of unfair competition in international trade. So against the dumping. So let's say the unfair or illegal abandonment of products or sales in the international market. So these laws would be environmental constraints that would affect decision making should we also go international or if we operate in international setting. Then decision making under environmental constraints also would be showing to us certain acts. This is in US though. If you are in the Philippines, this would not really affect us. So these are certain statutes or laws or acts that prohibit predatory pricing because there are some predators, as being said here, that would really price the products very low in order to penetrate the market. Although penetration of the market through smaller prices, so we call such as, let's say, the pricing is gonna dive low or go deep, then in that case, we call that penetration pricing, wherein we set prices low so that we can, of course, penetrate the market and we can get market share. However, if, for example, it's really low, like literally low, 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 then that's going to be predatory pricing, and that is unfair for the existing market players or businesses. So that's why these acts and statutes would prohibit such and protect the existing market players. Then here, I said, predatory pricing is pricing below cost in the short term to drive competitors out of business. And then later on, when they are out, that's a time that the prices would be raised. So that's how important that the government would really intervene in terms of pricing. So just like for DTI, for example, Department of Trade and Industry in the Philippines, that would be setting prices so that it would be friendly not only for the existing market players, but also for the new entrants in the market, so that the new entrants will be controlled on the sense or in a way of the pricing. Because there could be also some companies that, because they are big, so they can absorb the prices even if they're being low because of the volume that they can sell overall. So that's why the small players in the market would be sacrificed in the process since they have little sales and then they are forced to offer little prices also. So these are some situations that can happen with loss. Then the Robinson-Fatman Act forbids charging different prices to different customers unless there are intrinsic cost differences in serving the different customers. So in other words, this act forbids discriminatory pricing. So example, if we offer same products to different customers, then the prices should be the same. Intrinsic cost differences would be, of course, those additional costs, like for example, if we are talking about the transportation and other handling costs of certain entities from other places. So that may have slight differences of prices. So that's why ranges are very important. Then FTC, this is again under US, so protection, especially for the prices set. We don't have to dig much about this one. Anti-dumping, as what I've said, like illegal abandonment of sales or selling products, prohibiting a company in one country from selling its products in another country at less than fair value. So probably these are being large entities that can afford for lesser sales or lesser prices of their products, but they can still earn because of the analysis that we have made a while ago that we will only be focusing on the incremental costs. So by having the selling price and incremental costs which are low or lower in those countries, so they're going to dump the products there so that of course, that is just to be able to sell the products immediately and earn in the process than keeping them in the warehouse. So some laws would be there existing for anti-dumping. Example would be the International Trade Administration in the US. All right, so that's the end of our discussions, and hopefully you learned something from this session, everyone. So I love this particular color. Then hopefully you've learned something again, once again, for this particular second part of short-term non-routine decisions. Then I'll see you next time for another meaningful session for accounting related discussions, especially for managerial accounting. Thank you and God bless.